Welcome to Yahoo Finance Live. I'm Shauna Smith along with Dave Briggs. Let's get you up to speed on today's sell-off because the losses really accelerating throughout the day. And taking a look at where things stand with just about an hour to go. The Dow now off 734 points. Taking a look at an intraday chart here, you can see we're just off the lows of the session. Some of that selling that we saw after the Fed decision yesterday, of course, accelerating today. The S&P off just about over 2%, heading for its worst day in 2 months. The Dow having its worst day since September. NASDAQ 100, that's off just over 3%. A lot of those larger cap tech names really leading today's sell-off. Taking a look at some of the other action that we are seeing, yields also moving to the downside. Some fear there that the Fed may be going a bit too far. You're seeing yields off just about 6 basis points for the 10-year at 3.45. Taking a look at crude also moving lower today, off just about 1.5%, still above 76 bucks a barrel. And I want to take a look at Bitcoin because we talked about the movement yesterday, was holding on to gains. Today, though, trading lower, still well above 17,000. Taking a look at some of the more specific movers that we are seeing today. I mentioned the sell-off that we're seeing in tech, and you can see that reflected in some of the larger cap tech names. You have Apple off just over 4%, as well as Alphabet. Amazon off just over 3.5%. Inside the Dow, 29 of the 30 Dow stocks moving to the downside. Verizon, the only stock holding on to gains today. In the sector action, losses obviously being led by technology and communication services. All 11 of the S&P sectors, though, in the red. Semis under a massive amount of pressure today, as well as the financial names and some of the larger banks moving to the downside, Dave, on fears of a recession. And we know that econ data that we got out this morning was a bit concerning as well.
Brutal. Let's talk about some of that, and let's get you up to speed on the market-moving retail sales report. Shoppers pulling back ahead of the holidays with the biggest dip in nearly a year. Retail spending declined 0.6% in November after an increase of 1.3% in October. That's according to the Commerce Department. Americans did spend less on cars, gas, clothes, sporting goods, electronics, while they continue to prioritize staples such as groceries and eating out. For more on this brutal Thursday in the markets, we're joined by SEI Chief Investment Officer Jim Schmigel. Jim, nice to see you, albeit on a brutal day. Nowhere to run, nowhere to hide. Is Jerome Powell driving this sell-off?
Good to see you as well, Dave. I think you're right. He certainly is, but the economic numbers are helping him out, as you just mentioned. The retail sales report this morning was, I think, had a little bit of extra oomph to it, given the surprisingly strong report from October. The narrative that the numbers are building is that the economy is clearly slowing, inflation is clearly coming off, and investors are trying to digest that with the rhetoric from Chair Powell yesterday, which is that we're nowhere near target. They're not giving any indication that they're interested in slowing down, perhaps the pace, but no interest in taking the terminal rate of Fed funds any lower than, say, 5%.
Jim, the extent, though, of today's sell-off, any thought there that this might be overdone? And if not, any hope of a year-end rally? Is that pretty much out the window at this point?
I don't think it's out the window. I mean, I think that, again, this is the heightened volatility that we've seen. We're in this transition period. We have the lagged effect from the monetary policy that investors are trying to figure out how that's going to play itself out. The dual mandate and the confusion that the Fed is facing, I think the market is trying to digest as well. Weaker retail sales, higher Fed funds, and incredibly strong employment numbers even to today. Is there a chance for a Santa Claus rally? I think there always is. Basic kind of animal spirits. Is today ever done? Probably a little bit for a daily move. But the broader question is, what are we looking at into 2023? And we just have to talk earnings at that point, right? Our earnings estimates that are baked into the market at this stage, are they too optimistic? Do we have these wage pressures that are going to start to trickle their way through and start to eat at those margins a little bit? And that's what the market's trying to figure out.
Do you expect further downward revisions in earnings, Jim?
I have to say we do. Right now they're about, and they've been coming down, but right now they're still around 5 to 6% fairly broadly. And we will take the under on that. The strength in the employment market is the key factor there. We think those wage gains are going to finally start coming out. We're at the end of the year. This is the time of year where a lot of those things in certain sectors are discussed, where a lot of those are implemented. And I think we've seen decent earnings. We've seen some negative guidance, and it has kind of split along that angle that you mentioned earlier between goods producers and services. Airlines, as an example, doing fantastic. But broadly, 5% earnings growth in 2023, with everything that we see going on kind of across the world, we find that a bit optimistic.
So, Jim, what does all this mean then from an investment standpoint, just in terms of the uncertainty, the fact that you're saying it will likely remain volatile from here? Is it smart then to just stay on the sidelines?
I don't know if it's smart to stay on the sidelines. These things are notoriously difficult to call on a short-term basis. It certainly means to stay diversified. That's something that I think investors just don't hear enough. Having a diversified exposure and true diversified exposure, making sure that you have your portfolio that's geared towards your objectives, that you have enough growth assets involved in the form of equities and perhaps credit, that you have some nominal exposure that's going to give you some cushion in case there is a recession and the Fed does have to pivot. Inflationary sensitivity is something that we've been banging the table on for a few years now. We do think investors are still under allocated to it. The market is expecting a very, very big drop in inflation. We think that's going to come at a slower pace as well, and they would certainly benefit even today, if they haven't already, to get some inflation sensitivity into your portfolio.
Yeah, full circle back to the Fed as I'm searching for some good news, any good news. Is it that the Fed appears to be winning this war and we could be near the end of the tightening cycle?
I think that's what to focus on. We are closer to the end, of course, than we are at the beginning, right? We're at 4.5% on top line. Most indications, even if you look at the very aggressive dot plots that came out yesterday, we're going to be getting over, say, just over 5% or so. The pace of slowing has already slowed. So we had 4 75 basis point hikes in a row. We've downshifted to 50. The one thing about Chair Powell's testimony yesterday at the press conference, he was definitely open to further downshifting. Could we move on now to 25? We think that's possible. We think that's possible as early as November. And that's a great way for the Fed to slow things down, take a step back, and let all of the hard work that they've already put in, recognizing that they were clearly behind the curve, but letting all of those rate hikes make their way through the economy, giving them time to adjust and be that kind of data-dependent governing body that they claim to be.
Jim Schmigel, always great to get your perspective. Thanks so much for joining us today. We want to continue talking about today's sell-off. One of the driving factors in today's drop was that weaker than expected retail sales print that we got. It was the biggest drop that we have seen in nearly a year. So here to discuss a little bit more about that, we want to bring in Sharon Amartis, a Refinitiv Director of Consumer Research. Sharon, great to have you here back on set. So this drop, it was a 0.6% drop from October to November. Is this something that investors should be extremely worried about?
Absolutely, because this happened despite the fact that retailers were extremely promotional. In fact, this is the most promotional they've been all year, but also stronger than pre-pandemic levels. Refinitiv discovered in a collaboration with StyleStage. Now, what's interesting is that although more merchandise was on sale, the average discount came down a little bit, below the year-to-date levels and also below pre-pandemic. So this is telling us that retailers are offering more merchandise on sale, but they're discounting less in order not to hurt gross margins. And this strategy did not work. It did not entice consumers enough to open up their wallets. On top of that, November marked the first month that the unemployment rate hiked slightly to 3.7%, and also that media tech companies were announcing that thousands of layoffs. So as a result, consumers are, for the first time, concerned about the job security. The consumer confidence data of Refinitiv shows that for the entire year, consumers were optimistic they felt secure in their job. That's why they spent freely and went on travels. But now, for the first time, the entire year, they're concerned about their job security going forward. And so what that means is if the unemployment gets worse, they're going to put their hands in their pockets and hold back on spending.
The news about Black Friday was glowing. The numbers that Adobe threw at us, record-breaking Black Friday sales. How do you square that against this retail sales report?
Well, the retail sales report from the government is in line with the Refinitiv data that shows that for the holiday season, retail sales will, in general, the sales for retailers will be up 4% revenue. However, earnings are expected to decline 22.3%. And this is mainly because of inflation and higher costs. When you look at the 11 sectors, consumer sectors, 10 out of the 11 are expected to be negative and only one positive. And that is the hotels, restaurant, and leisure. So when we saw today's numbers of the government, where did consumers go shopping? They went to the bars, they went to the restaurants, and went and bought food in order to have those Thanksgiving dinners. But going forward for December, that's still expected to be the same trend. Consumers want experiences over things.
So, Jerome, then what does that mean for the retailers over the next couple of quarters? Because clearly consumers are pulling back on spending. They've already had a pretty tough couple of quarters leading up to that. That, of course, have been reflected in some of their inventory numbers, the fact that they were trying to avoid discounting, which clearly they don't seem to be able to do. So could we be in for a couple of ugly quarters then within that sector?
Absolutely. Definitely the holiday season will be ugly. And going forward to 2023, earnings are still expected to be healthy, but really what sets the tone for the earnings estimates is really the month of January. So once we have those numbers, we see that analysts tend to change those numbers accordingly to what happens or what the companies report.
What are the expectations in terms of margins being trimmed moving forward?
Yeah, so as you can see, retailers are trying not to get margins hurt very much. And there are some retailers that are actually doing better than others. Lululemon is one of them. Lululemon is one that consistently has been raising prices and has seen no change in demand. In fact, for the holiday season, they're expected to be the strongest performer, seeing comps of 22% on top of difficult comparisons. This tells you the underlying strength of that high-end consumer and the loyalty of that brand.
Even their margins were slightly smaller.
Right, slightly margins,
reports,
but still one of the strongest performers.
Yes.
So if you can imagine, even the strongest performer is seeing gross margins being hit, imagine the rest of the retail sector.
I guess we're trying to figure out how much worse it will likely get from here. When you take a look at today's print, month over month, it was a drop, but year over year, we're still up pretty significantly. Could we be looking at a contraction on a year over year basis within the next couple of months, maybe within the first half of 2023?
So at least for November, December, January, for sure. That is guaranteed. That we're already seeing.
On a year over year basis.
Right. But then coming into January, those expectations could still change. As of right now, the expectations are that 2023 there'll be some improvement based on the fact that, yes, the labor market sadly might deteriorate and the Fed might loosen up their tightening. But other than that, January will really set the tone, and also the employment number more than anything.
Again, with the caveat, I am searching for positive news. Is some of this because of prices having come down a little bit naturally going to be reflected in lower spending numbers?
So it's important to note that consumers are not buying things, but they are still spending. So I want to point out that restaurants are expected to be extremely strong. In fact, when you dig into the restaurants' numbers, fine dining and casual dining, they're outperforming quick service. Consumers want to go into the restaurant, sit down and have a meal, and they're going to pay for it, despite the fact that the prices are higher. It's just that they are not going to go to the mall to go shopping.
Whew,
That's your piece of good news.
Hey, yeah,
if anything,
I'm still
people
searching,
are still
man.
want to go out to eat.
I will continue
take it.
to search. Sharon Martis from Refinitiv, good to see you. Thanks so much. All right, we're just getting started here on Yahoo Finance Live. Coming up, with rates rising, our next guest says 2023 will be a survival of the financially fittest scenario. Find out what else this regional bank CEO is telling his clients. And Elon Musk selling more shares of Tesla. Should you? An analyst tells us. Also, Netflix shares falling over concerned about its new ad tier. Don't go away.
we need to be honest with ourselves that there's, inflation, 12-month core inflation is 6% CPI. That's 3 times our 2% target. Now, it's good to see progress, but let's just understand we have a long ways to go.
That was Fed Chair Jay Powell reiterating his hawkish stance and saying that more rate hikes are going to be needed. The market's selling off on that today. The Dow headed for its biggest decline that we've seen in just about 3 months. So here to discuss what this means for the banking sector, we want to bring in Frank Sorrentino, Connect One Bank CEO. Frank, it's great to see you. So clearly Wall Street's a little bit worried about the hawkish stance that we got from Fed Chair Jay Powell yesterday, the fact that the Fed remains committed to raising rates in order to get inflation under control. What's your reaction to what we heard and today's sell-off?
Well, I don't think it should be any surprise to anyone. And by the way, thank you for having me on the show again, Shauna. But it should really be no surprise. The Fed has been pretty consistent around this idea that maybe they were a little bit late to the party, and now they have some real work to do, and they're going to continue to do it until the job is done. And so, as we all know, part of it is what the Fed actually does, and part of it is what the Fed says. And the Fed is absolutely telegraphing a very hawkish stance going forward. No surprise that the market's reacting this way.
A determination, and good to see you, Frank, a determination to get the job done, despite what appears to be forcing a recession. Do you think we're headed towards one early 23?
So look, there's a whole big difference between rising rates, the qualitative tightening, the Fed's commentary, and what's actually happening on the ground. We are definitely seeing inflation subsiding in areas where we want to see those things happening. But there are issues that are probably global and macro that are going to be difficult to control. The issues that are happening around the globe, some of the conflict, what's happening with energy, these things are definitely impacting all the insourcing that we're doing here in the United States. It's talking about bringing jobs back into the United States. These things are inflationary. We just went through a pandemic. We had supply shortages. There are lots of things that are going on that are going to be more difficult to bring under what the Fed calls control than may be possible. I do think that the Fed understands at some point they're going to have to level off their rate structure. And I think we saw a little bit of that yesterday. To me, there's actually some good news that they're beginning to take their foot off the pedal. When you think about the U.S. economy today and you think about the U.S. consumer, they're in the best shape that probably they've ever been.
That's a bit of good news. That was positive. The most positive thing we've heard since we started the show. Frank, when taking that into account and comparing that then to what we've seen play out in the market, because I would argue Wall Street is viewing this very differently. When you take a look at the consumer today, what is the reason then to remain positive in the face that inflation, albeit improving, still remains extremely high on a historical basis?
So look, let's move away from what maybe the Fed is actually saying, and let's look at the facts on the ground. Here at Connect One Bank, our clients are telling us, and we're seeing by working with our clients and looking at them, that they probably have the best balance sheets that they've ever had, both consumer and business-wise. There's more liquidity on their balance sheets than probably they've ever had. They have more equity in their accounts, whether it's in the markets or whatever, or in their businesses, the values of their business. We still have a labor shortage. It is difficult to hire. All businesses today are reporting a difficulty. And this is one of the big challenges that the Fed's going to have, is in order to really break the back of inflation, they may have to do some damage to the employment numbers. And that's a very, very sensitive area. But all of our clients are reporting difficulty in hiring high quality people to fill jobs. People have higher wages today than they've had in the past. We're seeing that in all of the due diligence we do on our clients. And so we just heard, retail sales are up. People are out shopping. They're out in restaurants. They're going out and doing things. So yes, inflation is headed down, and it will continue to head down, is what my belief is. Oil is now back to pre-pandemic levels. I believe that we will see inflation come down a bit. And yes, the market has reacted, but let's see what happens tomorrow or the next day or whatever. The market has a habit of jumping ahead of the news very quickly and then changing its mind. But when you talk to the clients on the ground, you talk to people who are running their businesses, things are still pretty good.
A bit. Interesting to say inflation will come down a bit. Doesn't sound like 2% the target. What are you telling clients given the uncertainty of the environment at 23?
Yeah, with all that's going on around the globe and here in this country and what we've just gone through relative to the COVID pandemic, I find it hard to believe that we're going to get back to a less than 2% inflation world. And I do believe that the Fed will be happy if we get sub 4%, if we get into that, let's call it 2 to 4% range. I think that last, it's sort of like losing weight, the first chunk is easy. And then, as you go along, it gets harder and harder. I think that last little bit to get closer to 2% is going to be very, very difficult to do with some of the transformative things that are going on in this environment. That being said, if we got closer to 3, I think everybody would be very happy.
All right, I think people would be very happy if we get closer to 3, considering where it is today. Frank Sorrentino, always great to have you. Connect One Bank CEO. Thanks so much for joining us.
Thank you.
All right, well, coming up, it has been a nightmare year for Snap. Look at that chart. Year-to-date shares off just about 81% despite that drop. One analyst saying that there's still too much optimism surrounding the stock. Stay tuned for the details next. It's time for our triple play. 3 stocks that we're watching in the final 30 minutes of trading. We have Amazon, Netflix, and Snap. Ali Canal here on a set with us to talk about some of these big movers. Let's kick it off with Amazon. The New York Times reporting that the tech giant has reached an agreement with the EU to changes to some of its business practices. So the announcement, which is expected next week, is going to require Amazon to give other product makers equal access to valuable placement on its platform, something that it has been criticized for in the past. The company is also it will also block the company, Amazon, from using third-party merchant information to develop its own products. So Ali, the big takeaway here is we know the EU has been very aggressive with some of the larger tech giants in terms of antitrust allegations, what companies should do going forward. So if this agreement is in fact announced next week, I think investors are going to want to know what this could mean for Meta or some of the other larger cap tech names that have come under fire and under criticism over there in the EU.
Absolutely. And we got that report from Bloomberg last week that Apple will reportedly allow third-party apps on its app store in the EU. So that's something to watch as well. And I think there's just this larger criticism when it comes to competition in the space, antitrust in the space. We've heard from Elon Musk, we've heard from Spotify CEO. They've all been super, super critical with these tech giants, and the EU really seems to be the force behind this, certainly ahead of the US. So that's something to watch in the US as well. My pick today is Netflix. The stock slumping today, down at 9%, the biggest intraday drop since April after a new report from Digiday said the streaming giant is falling short on viewership guarantees it made for advertisers for its new ad-supported tier. According to Digiday, which cited 5 agency executives, Netflix is now allowing ad buyers to take their money back after missing those viewership targets. The company reportedly only delivered about 80% of the expected audience. Now, this is something that's a big deal because a lot of the upgrades that we've seen on this stock has been around the optimism for the ad tier. Now, we heard some analyst reaction today saying this is not cause for concern. It's still early days for the ad tier, but in the long haul for investors, this is something that is super important.
No question. And if you just close your eyes for a minute, it feels like all the buzz is surrounding Netflix at the moment. A huge hit with Wednesday, a massive hit that I did not expect with this Harry and Meghan.
Loved it. Everyone should watch it.
Did you see
I
it?
loved it.
I did not get a chance
this
to watch
thing
it
is
yet.
crushing it. Everyone's talking about it. Everyone's talking about Wednesday, but yet you hear a lot of pessimism. Laura Martin joined us yesterday, said she sees Netflix as a loser based on 2 things. They don't have a dance partner, no theoretical bundle unless they're purchased, and also they have no international growth because they're already there where others are still going there. So it really is surprising given all the buzzworthy content they are continuing to turn out, Shauna.
Yeah, certainly extremely concerning here because going back to what Ali said, a number of the positive calls that we've heard from the street over the last several weeks or last several months really was in anticipation of their ad tier. So if that doesn't perform up to expectations, it could be an ugly 2023 for the stock.
Indeed, it could. All right, my play is Snap. The stock down 80% this year. Still, one analyst says it's got further to fall. Jefferies' James Heaney saying, quote, "We believe Snap will continue to face several headwinds, including iOS privacy changes, a worsening macro picture, and intense competition." Heaney calling for 2% revenue growth in 2023. That's against a consensus of 9%. He's also cut their price target from $12 to $10. There was some initial optimism surrounding Snap with bipartisan legislation emerging that would ban Chinese-owned TikTok. That has all but disappeared. Shares have now fallen more than 9% today, and it's hard to imagine, Ali, what the catalyst is for Snap rebounding and having a comeback.
Yeah, Snap, and there's also the advertising, the macroeconomic picture. That's something that's been impacting really every entertainment media sector. Roblox today also off, gaming. So that's something that's been hard to avoid. And also the relevancy of Snapchat too. How many people are using Snapchat? Is the younger generation still attracted to it? But this is a stock that I feel like we talk about constantly because it's so up and down.
We do. We talk about it
Mainly
constantly.
down.
Mainly down over the last year.
Yeah.
Off just over 80% year to date. It only comes up positively, I feel like, when we talk about these Gen Z surveys. It's extremely popular among Gen Z. It's always the top app, if not one of the 3 top apps that this generation uses. So they need to figure out how to monetize it a little bit more. They need to be a little bit more creative, I think, going forward. That's been a huge criticism, just the fact that they haven't really been too innovative in terms of their product. They've had the same exact product for years now.
They need to lobby DC.
They do.
They need TikTok banned.
But I
they
wonder
really
how much
do.
that's really going to help.
Oh, I think
though,
it's the closest alternative.
It's the
other
closest
than Reels.
alternative, yeah, but I also wonder how much of Gen Z, their largest user base, is already using both of these apps. But I guess the question is how much more time they're going to spend
And it's a huge advantage, right? For Snap, a lot of these companies, Spotify, all these companies are trying to figure out how to cater to Gen Z. So the fact that Snapchat is already there.
There we go. We're doing a positive spin on this.
It's something that they need to take advantage of, though, in order
Lobbyist.
There you go.
Yeah, we will see. I don't know.
going to DC.
Shares off 80%. We'll see what they do in 2023. All right, coming up, Senate Democrats and Republicans coming to a unanimous agreement on TikTok. See what the legislation they are pushing. And shares of Roblox falling sharply today after the gaming company delivered some bad news to investors in terms of November numbers. We got that for you when we come back.
Who knew TikTok would be the one thing that could bring Democrats and Republicans together? The Senate unanimously approving legislation banning the use of TikTok on government devices. This is just the latest move against the China-owned social media platform. Ali Garfinkel here with the latest and where we're headed next. Ali, a lot of pressure here on TikTok.
Yeah, who knew, right? But Dave, pressure is building on TikTok from Washington and lawmakers generally. It's pretty clear. However, I think it is important to be very, very clear about the specifics here. So the Senate today passed legislation to ban TikTok on government devices, specifically government devices. And though there is a companion bill in the House, that bill hasn't left committee yet. We do know that it's worth saying there are some members of the House, including Rep. Katie Porter, who have TikTok accounts. So I think it remains to be seen how someone like her is going to be affected by this legislation down the line. Now, at the same time, Dave, we're also seeing more states talk about banning TikTok. Yes, still on government devices. Those states right now include Alabama, Utah, Idaho, Texas. So there are a couple of things here. First, this is certainly a step forward on government officials ratcheting up pressure on TikTok. That said, the ban hasn't come for consumers yet. My take here, Dave, no experts I'm talking to still believe that a full-fledged ban on TikTok in the U.S. for consumers is likely. But this is a sea change. You know, for me, I've been wondering if social media apps should be on government devices at all. And I think it'll be interesting to see if this dialogue expands beyond TikTok in the long term. Who knows? But I think it's an important question to ask.
It is indeed. I was hoping to talk to Katie Porter about that, asked her to come on the program, declined, but we'll keep the pressure on for you, Ali. Thanks so much. It is an interesting point when we talk about TikTok, Shauna, because look, my kids are on TikTok. I don't have a whole lot of concerns, although I've spoken with Senator Mark Warner about the dangers of this and the Chinese data collection. What are they going to collect on a 14-year-old kid? There ain't much there. But in terms of our congressmen and our senators, that should have been passed long ago. I'm actually surprised we got to the point that we're in now, still allowing government devices to have TikTok on it. That ought to be a national security concern. And Katie Porter's crushing it there. Come on the program. She's got 381,000 followers. She's crushing it, but I assume that account's about to go away.
Yeah, certainly. And it's going to be interesting to see how it plays out in the House. And then when we talk about a broader ban of TikTok, Ali just saying that is unlikely. It is interesting, though, because it does have bipartisan support. There's been a number of lawmakers from both sides of the aisle voicing concerns there that they think it should, in fact, be banned. SEC Commissioner Brendan Carr was on the program saying that anything but a full-out ban is not something that we should be accepting right now because of the national security concerns. I'm not too sure that we are going to get that, but we will see. And certainly this is a conversation that isn't going away since it does have bipartisan support.
I'm obviously a little more, optimistic that I think there is a chance, although I was shocked here because Josh Hawley is the one who introduced this legislation in the Senate, arguably the most controversial senator in that body. So I was shocked that there was unanimous consent of this. No one dissented against this banning on government devices. That tells you a lot. There is an urge to block anything Josh Hawley puts forward in the Senate. No one dissented. Yeah,
it's a very good point there. All right, let's also talk about another big story today, Roblox. That stock is tanking, now off just about 16%. The move lower coming after the company's revenue growth slowed in November from a year ago. Strong U.S. dollar, partly to blame. Dan Howley here on set with this. And Dan, when you take a look at the gaming sector, obviously slowing industry-wide, but Roblox there, slowing growth, a huge concern for the street.
Yeah, whoa. So revenue growth in 2021 was 102% for the quarter, right? Revenue growth for this past quarter was 2%. Whoa, that is a huge difference, right? I think obviously part of this has to do with the fact that a lot of kids had started getting on Roblox at that point. It kind of was exploding more in popularity. I think there was more awareness of it as a result of the pandemic. I think the more concerning issue is the slowing growth as far as hours engaged. They had 11.2 billion hours engaged, a 28% year-over-year increase in 2021. This past year, 13.4 billion, only a 20% year-over-year increase. So, Roblox is slowing as far as growth goes, and this really kind of speaks to the broader issues we're seeing across gaming, where there's fewer people that are engaging as much because we're not glued to our couches.
Yeah, Dan, exactly. And Roblox by far not the only, far from the only company that is putting up numbers that are disappointing the street. We just heard from Take-Two in their most recent earnings report. They lowered their guidance for the current quarter and also out to 2023. Do you see anything changing that narrative just in terms of a return to growth here in 2023, or do you think it's going to be a pretty consistent story?
Yeah, I think, it depends, right? I think next year will be a better year. It's the comps to last year were crazy for a lot of these companies. And, as far as the big name game companies, the Take-Two, the EA, the Activision, Blizzard, the Sonys, Microsofts, Nintendos, they kind of were the victims of their own success in 2021. 2022 also didn't have that many huge games that really blew people away. You had Call of Duty, sure, did $1 billion in 10 days, massive for Activision Blizzard. But there weren't really too many big tentpole releases in this holiday season. A lot of stuff got pushed to 2023. So if anything, that's going to be a boon for next year. And I think, as far as the gaming industry in general, mobile gaming is really taking a hard hit. That's the same reason that we're seeing it for general gaming, but also because advertising, digital advertising is falling, hello Facebook and Snap. So the same impact is being felt at mobile as far as mobile gaming goes. So it's this two-pronged attack, I think, for game companies, especially with the mobile side, because that's the fastest growing part of gaming. So I do think 2023 will be better, though.
But again, another reflection of the retail sales, a shifting of spending away from goods, away from electronics, towards services, towards travel, towards experiences, not including gaming at home.
Are you gaming as much as you were in
Oh
2020?
my God, yes.
There you
That's
go. You're
crazy.
helping these companies
I play
out.
video games with my wife every night. It's awesome.
I know you do. Yeah, you're one of the customers that they can always count on.
I was at the
Me, I
store
don't think
buying
I've-
Pokemon.
Yeah, I don't
That's,
think
you
I've
know.
done gaming since maybe I was like 7 or 8 years old, and it was like the
teenagers,
original Nintendo.
I haven't seen them game in my house in almost 2 years.
Really? That's interesting.
Yeah.
That's very interesting because the younger generation. All right, well, coming up next, stocks taking a hard hit today. Once again, a sell-off across the board. Dow now off over 2%, headed for its worst day in about 3 months. The drop coming following the Fed's decision yesterday. We'll talk more about it when we come back.
Markets tumbling after Fed Chair Jay Powell reiterated his hawkish stance and warned of more pain ahead. The SP 500 ETF, ticker SPY, selling off on the news. For more on this and the road ahead, we have Sean O'Hara with us, Pacer ETF's president, as part of this week's ETF report brought to you by Invesco QQQ. Nice to see you, sir. If there was an enduring message from Jerome Powell that's reflecting in the markets today, what is it?
That they're not giving up. They're still committed to trying to stem the tide of rising prices and inflation. They're not convinced that their job is over yet. And so we'll have to continue to watch what they do. It's a little surprising, to be honest with you, that we had some bad economic numbers on the manufacturing side. We had some bad retail sales numbers this morning come out. And so it looks like what they've been doing, which sadly is trying to destroy a certain part of the growth in the economy to tamp down inflation, is starting to work. And so, it's a little surprising that the market doesn't view that as a potential, good news story in the bad news that's wrapped up in it, because it would be an indication that what they've done so far is accomplishing their goal, and perhaps they don't need to be quite as aggressive as they have been. But as of yesterday's, Mr. Powell's speech yesterday after their meeting, it doesn't look like they're going to stop along their path of continuing to raise interest rates.
So, Sean, what does all this mean then in terms of a risk of recession? And if we do get a recession, how deep could that be?
Well, I think it's possible we're already sort of in a recession, and we got here because the Fed said that inflation was transitory, and so it got away from them, right? And so now they're having to be sort of overly aggressive to kind of rein things in. And I'm concerned that over aggressiveness might not result in what they're hoping for, which is sort of a soft landing. I think we may have potentially a little bit harder landing than what people think. And so, if there's good news in that, historically speaking, that the stock market tends to react 6 months in advance of that recession starting. And so, if we're nearer to this recession starting, if there's going to be one, if there's a silver lining in there anywhere, we may be closer to a near-term bottom in the market.
So given what we're seeing in the market today and your prediction of a hard landing, what are you telling investors? Any sector safe to hide?
Well, this year, we have succeeded in creating positive returns from one of our large cap ETFs, COWZ, by positioning the portfolio in energy, healthcare, and materials and moving away from consumer discretionary and tech. It's not likely that that will change anytime soon. So I think you have to be in some of the more defensive sectors. I think if you think about where to invest in this kind of an environment, high quality stocks that generate a lot of free cash flow, that have a high free cash flow yield, are things we love. They tend to pay dividends, grow dividends, and buy back their stock. Or strategies that people can use to sort of mitigate some of the downside risk. And we have a strategy that ALTL is that ticker, and it moves from high beta to low vol, and it's been in low vol most of this year. And so on a day like today, it's down a little bit, but it's only down about half the market's down. And so those types of strategies in this type of environment have worked out pretty well for the investors here at Pacer ETFs who own them.
Yeah, Sean, within the healthcare sector, that's interesting because we know the healthcare sector has fared better than the S&P this year. When you take a look at BlackRock and also Fidelity, they have two large healthcare ETFs that have actually outperformed the S&P by about 10% year to date. More specifically, when you're looking within that sector, I guess, how are you picking out the winners and losers?
Well, we screen for free cash flow yield. So the free cash flow yield is the free cash flow a company generates divided by its enterprise value. And enterprise value is market cap plus debt minus cash. So it's essentially a calculator that says, what am I going to pay in total to buy a stock? And how much free cash flow will it give me in terms of current return? And so that's what's led us to the healthcare sector. Earlier this year, energy was carrying all the weight for our portfolios because we were very, very heavily weighted energy. We still are. But I looked yesterday, and I think 6 out of our top 10 names are healthcare names, like Moderna, Regeneron. Gilead is in our portfolio, AbbVie's in the portfolio. So, the interesting thing about the healthcare sector, Shauna, is that it's the only sector that has not seen over the last decade or so its stock prices go up faster than its earnings. Tech at one point had seen their stock prices go up more than double their earnings. And so that's what I think we're seeing in the tech sector right now, is sort of a compression of that multiple. Same thing is happening to growth stocks broadly. But healthcare, the stock prices actually went up less than their overall earnings. So we're not subject to that same multiple contraction in healthcare. And so as a defensive place to be, it's been a real big winner for us.
So message here, stay defensive, at least for the first part of next year. Sean O'Hara, great to have you. Thanks for joining the show this afternoon.
Thank you so much.
All right, well, coming up, more Gen Zers are living at home, not just so they can save money, but they're also spending some of it too. We've got the details for you next. U.S. Census data revealing that nearly half of all young adults ages 18 to 29 are still living at home. That's one of the highest marks that we've seen since 1940. There's a new report out from Morgan Stanley, and they're saying that higher rents, greater enrollment in higher education, and also the fact that people are getting married later, that's all to blame in this. So since this group of individuals, they're avoiding the high cost of living, well, that has actually boosted some of the spending that they are doing on luxury goods purchases. So Dave, they're staying at home because we all have been talking about the fact that rents have risen so much. They're trying to avoid that. They don't have to pay for dinner, for breakfast, for lunch, the cost of living that all of us have to do.
Rent.
So with some of that money that they're saving, Morgan Stanley saying that they're using that, spending it on luxury goods. Good news for those brands. Questionable decisions, though, there, I think.
Yeah, I'm trying to reserve judgment, but clearly on my face, it's written all over. Said Morgan Stanley, we see it as fundamentally positive for the industry. How is it for society? Not so good. I would prefer these kids pay their parents' rent and start to learn about the economy and some financial literacy. I am happy for the richest man in the world because he is in the luxury goods industry. But this is strange sense of priorities. It is really warped. Luxury spending up, 22% in 2022, largely driven by Gen Z living at home. This is just a bizarre trend, one I'm not thrilled with. Good for the industry. Does make up for somewhat the pullback in China. The COVID lockdowns have really hurt luxury goods spending, in particular, really a market that drives it. So I guess it's a makeup, but I'm larger concerned about what they're learning through this experience.
Yeah, I'm a little bit concerned about that as well. Obviously, like you said, good news for these brands because these Gen Zers are becoming customers early. The thought there is that they are going to keep being customers as they get older and they make up more and more or account for more of the luxury spending overall on a global basis. It's important to point out this isn't just a U.S. trend because over in the U.K., I want to point out, 15 to 34-year-olds there, that number living with their parents has climbed to about 42%, up from 35% in 1999. So it's not just Americans that are deciding to live with their parents longer.
Yeah, see your kid bringing home a Louis Vuitton bag and they're not paying rent, do something about it.
A lot of questions.
Coming up, we're counting down to the closing bell on Wall Street. Stay with us here on Yahoo Finance Live. We are just a couple of minutes away from the closing bell on a brutal Thursday. Jared Blickery, what is the deal, man?
That's right. Well, this is day 2 of market participants pricing in the latest Fed announcement and Chair Powell's presser, widely viewed to be hawkish yesterday. Growth stocks, especially those that are cyclically levered to the growth cycle, the business cycle, they're taking the hits the hardest. We're seeing this in mega caps, semiconductor, and disruption stocks. So let's take a look here. This is the NASDAQ 100, the mega caps situated over here. Apple down 6%. Over the last 2 days, NVIDIA also down more than 6%, Alphabet more than 5%, Amazon more than 4%. And if we take a look at the sector action, really tells you why some of those mega caps are under pressure. Communication services, that houses Meta as well as Snap and Verizon, interesting mix there. That's down the most, down 5%. 4.5% is what tech is down by, 4% materials, and then also financials. So within the tech sector, I mentioned semiconductors, very highly levered to the business cycle, and you can see a lot of these taking huge hits. AMD down 7%, NVIDIA down 6.1%. Want to check out financials real quickly. They don't like what's happening with the yield curve right now, so beggars can't be choosers. JP Morgan down 3%, so is Bank of America over the last 2 days. And then taking a look also at the disruption stocks, the ARK components. These are the top 20 in the ARK Invest portfolio, and you can see all of these down except for PagerDuty, which is up 1.3% over the last 2 days. But Roblox down 13%. We were talking about that earlier. Unity Software down 12%. Roku down 11%. Now, Novavax, and we got to go to the pharmaceutical sector to see what's going on here. Novavax, this is one of those vaccine stocks that has been really obliterated. I think it's down something like 97%. Guess what? It is down 30% today alone. Now, you check out the year-to-date number on that. I'll get to the news in a second, down 92%. The vaccine maker announced today that it was offering $250 million in equity and convertible debt, and that is to repay the UK government $112.5 million. And that's after the British cut its supply, the vaccine supply agreement, in half. So Novavax not supplying as many vaccines to the British as they thought, and as I said, down considerably, not only from the start of the year, but also from its record high. Now, also want to check out Nikola in the EV space. This is an interesting story. We remember the fallout from the original founder, that would be Trevor Milton. Let's see if I can find Nikola down here at some of the bottom levels. Oh, here we go, down 1.9%. This has to do with ex-CEO Mark Russell. Now, he's still on the Nikola board, and he's been selling the company's stock nearly every single day for 3 months for a total payload of $17.2 million for 1 million shares. And this leaves him with 1.96 million shares left. So we're going to see how this plays out, but just another nail potentially in the coffin for Nikola. Here's your closing bell.
That was aggressive.
That was aggressive. Lots of excitement there, lots of happiness, it looks like, on that, following what has been a brutal day for the markets. But we'll take it because, Dave, like you said to start the show, we're looking for any sort of optimism today. That hammer is exactly what happened to the market today. That is good. Yes, that hammer is
aggressively hammered downward.
What happened? You can see it reflected on your screen. The NASDAQ, the worst performer of the 3 major averages. Larger cap tech names leading to the downside here. The worst performers in the market. S&P off about 2.5%. The Dow off 763 points. The worst performance that we've seen for the Dow since September. Let's take a closer look at some of these losses, what it means for the coming weeks. We want to bring in Sam Stovall, Chief Investment Strategist at CFRA Research, and also Kevin Flanagan, Head of Fixed Income Strategy at Wisdom Tree. Sam, to you first, just in terms of the sell-off, the magnitude of the sell-off today, what we heard from Jay Powell yesterday, any sort of overreaction, or were you expecting this type of selling today?
Well, no, I was not expecting this kind of a selling, but I think what it reflects, it's sort of like a deflating Santa Claus lawn ornament that tends to reflect the diminishing investor optimism that the U.S. will avoid a recession. So I think that's what's happening is investors were thinking that the Fed would say something a little less hawkish, maybe even hint at the end of the rate hikes by early next year, the first rate cut by the end of next year, and they got none of that. And so what they're doing is reverting back to a more defensive posture.
Kevin, it's interesting. Jerome Powell has been remarkably consistent throughout most of this tightening cycle and was yesterday. It's almost as if the markets weren't listening and finally heard what he said. What do you make of it?
Well, I think for the bond market, especially for the Treasury market, they're not, essentially buying what Powell's trying to sell them at this stage of the game. I mean, his comments have been, as you mentioned, very consistent. And I think the fact they raised the dot plot, so the median estimate for Fed funds to 5.1%, it's kind of remarkable to see just front end Treasuries not responding at all. I mean, if you look at a Treasury 2-year yield at 4.25%, we're essentially underwater now. We're under, for the most part, the current trading range for Fed funds, which is essentially unprecedented. So I do think this disconnect is somehow going to resolve itself. I think perhaps after the holidays, that if we continue to get numbers, I know retail sales, as you mentioned earlier, we're certainly on the disappointing side, but jobless claims, that's what the Fed's focusing on, the labor market. Jobless claims fell to their lowest level, I think, since September. So labor market demand is still there. And Powell, I think, made it pretty clear. I think that's the new indicator we should be looking at.
Sam, what does this mean for the market then in 2023? Because certainly sets us up for a very challenging couple of months.
Yeah, I think that what we're likely to see is a first half that is very different from the second half. I think we do end up seeing the Fed raise rates by 50 basis points in February, another 25 in March. I think we do tend to retest the October 12th low and maybe even set an even lower low. But I think beyond that, investors are going to be looking across the valley and realizing that on average, the Fed has started to cut interest rates about 8.5 months after their final rate hike. So that would put us squarely into December. So with the Fed reminding us that they are data dependent, should we end up with a weaker than anticipated response by the economy, I think the Fed will have to shift course.
Kevin, you mentioned that renewed emphasis on the labor market, on services, on wage growth. Do you think a terminal rate just north of 5 will actually break that labor market? We've seen zero softening thus far.
No, I don't think it breaks the labor market. I think what the Fed is looking to do is to just slow it, right? I mean, just from a political perspective, it'd be tough for him to testify on Capitol Hill that was their goal. But I think what the Fed's trying to do is to continue to soften the demand side of the ledger. And as we go forward, what Sam was saying, I think that's a very likely or reasonable case scenario that the Fed does get us to that new dot plot of, say, roughly 5%. For lack of a better way of saying it, and then, in fact, considers perhaps, behind me here, maybe Powell, instead of coal, put something good in that stocking a year from now.
And Sam, despite this challenging setup, we know that the consumer has remained very resilient, yet we got that retail sales number weaker than expected, a bit concerning here for investors. Do you think that trend, I guess, is starting to shift? And what does that mean for the retail sector or some of those consumer discretionary names?
Well, what's interesting is that you would think that it would cause the consumer discretionary group to really head south. But if you look at a relative strength chart of the S&P equal weight consumer discretionary group versus the market itself, you're actually seeing that it came off its bottom of June of 2022 and is working its way up to the point where it's now pretty close to being on par with the market on a rolling 40-week basis. So I think that there is optimism that the consumer will be able to withstand this. What they're doing is they're pulling back because of the concerns that they hear about, that they read about, et cetera. But with the employment picture still looking so healthy, they do end up having the money to spend.
Kevin, anything just to end this, hopefully on a positive note, anything that we should be optimistic about at this point?
Yeah, I mean, I do think that if there was any silver lining in the bond market, it's that the worst year perhaps on record for fixed income is setting ourselves up for perhaps a pretty good year, maybe in the second half of 2023, once the Fed does go on pause and perhaps considers rate cuts a year from now, fourth quarter next year, say, that we could actually look back and say, hey, this wasn't such a bad year for the bond market. You have yield levels that a generation of investors have never witnessed before. So there's income back in fixed income.
All right, we'll leave it at that. Kevin and Sam, great to have you. Thanks so much for joining us this afternoon. All right, well, coming up, Tesla's troubles are just beginning. Our next guest saying that Elon Musk's funding of Twitter could continue to affect the EV maker's shares. We'll speak with Morningstar equity strategist Seth Goldstein after the break.
Most of us need cash. We go to the ATM. When Elon Musk needs money, he goes to Tesla. Elon selling nearly $3.6 billion in shares, according to an SEC filing. He's now sold more than that massive number on your screen, $23 billion, since tweeting, ironically, no further Tesla sales planned in late April. The stock is down more than 60% this year, and our next guest says it's undervalued. Morningstar equity strategist Seth Goldstein with us now. Seth, good to see you. Before we dive into the Tesla stock and the road ahead, what is your reaction to him selling another $3.6 billion and the Twitter distraction overall?
Well, it's clear that Twitter is an overhang on the Tesla stock, and I think Musk may not have anticipated not being able to secure as much permanent financing for Twitter, and as a result, he has to sell Tesla shares to plug the gap and to fund Twitter to get it on its long-term growth plan. So this may not be the final share sale. We could continue to see more sales into 2023 as Musk looks to get Twitter on the right track, which could continue to be an overhang on Tesla stock.
So Seth, you don't see any of his action, any of Elon Musk's action over the last couple of months. You don't see that really impacting Tesla's brand. And then I guess pushing forward there, just the distraction of it, the fact that he's spending so much time at Twitter and not at Tesla. How are you looking at that from an analyst perspective?
Well, it certainly is an overhang on the stock. And, I think that might leave some investors cautious to get into Tesla shares, even as we see it continue to sell off. However, when we look at the underlying Tesla business, they're continuing to meet their growth plans. The 2 new gigafactories are ramping up. In fact, just earlier this afternoon, Tesla tweeted that the Austin gigafactory had hit the milestone of 3,000 cars produced a week. So that's continuing to progress as planned. The insurance business is continuing to roll out to new states, and the full self-driving software is continuing to make progress and get to the subscription full rollout. And so when we look at Tesla as a company, we see that they are hitting their growth plans. They're meeting their milestones. However, Musk's time with Twitter and the potential for further sales are continuing to weigh on the stock.
Yeah, you still view it as undervalued. Price target of $250, nearly $100 more than it sits today. What is the real catalyst to getting anywhere near that point?
Well, I think we first have to get rid of the Twitter overhang. So that means Twitter needs to secure permanent financing, and either Musk or Twitter needs to give an indication to the markets that, Musk will not need to sell shares of Tesla to fund Twitter. Then I think we need to see Twitter have a permanent CEO be named so that Musk can go back to spending most of his time running Tesla. At that point, I think we need to see Tesla continue to meet its milestones, ramp up production, ramp up deliveries to show to the market that there's no demand problem. And at that point, I think we could see the shares start to rise and get closer to my $250 per share fair value estimate.
So Seth, when do you see the momentum then changing on the stock? Is this something that you see happening in a month or two from now, or is this something that's going to take maybe 9 to 12 months?
It all depends on the Twitter overhang. If Musk were to come out in early 2023 and say, the Twitter financing is secured, we've named a new permanent CEO, then I think that goes away, and then the market starts to focus on Tesla on a standalone basis. However, if this drags on throughout 2023, then it could continue to weigh on shares.
All right, Seth, so Twitter overhang aside, what about demand? Because that's a concern for Tesla. What about pricing? That's something that a number of analysts have been talking about heading into 2023. What's your outlook there?
My outlook is for Tesla to have another solid year of seeing solid double-digit deliveries growth. And remember, while there is EV subsidy expiration in key markets like China and some EU countries, Tesla will benefit from the Inflation Reduction Act, re-adding U.S. subsidies, which is still Tesla's largest market. So I expect, even though we're heading into an economic slowdown, that Tesla demand will still be strong. And as they ramp up production, they'll be able to sell all models produced.
Does Tesla need a new CEO?
I don't think so. When you look at Tesla, even with Musk focusing on Twitter, they're still meeting their underlying goals. If we were to start to see Tesla not reach their goals, not ramp up production, not make progress on the ancillary businesses, then I think it'd be fair to say they might need someone to step in and run Tesla full time. But, as long as they're still continuing to meet their operational goals, then I think Tesla's doing just fine.
So let's be clear, Twitter needs a new CEO.
Yes, I think, and that was always the plan. Musk said he would take over temporarily until they were able to find a new permanent CEO. And I still think that's going to be the case. And I'd imagine that search is underway as we speak. But until something is announced, that's still going to be an overhang on the market, questioning how Musk is spending his time and if he needs to focus more on Tesla.
All right, Seth Goldstein, very positive on Tesla. We'll see if it gets to $250 a share. Thanks so much for joining us. All right, well, we are just about a couple of weeks from the end of the year when many workers are looking to spend less time in the office, more time with family and friends. One company is making that happen. Citigroup telling employees that they can work from anywhere for the last 2 weeks of the year. This is according to Bloomberg. The only caveat, though, you must stay in your country of employment. So no jet setting to Paris if you're a U.S.-based worker. Now, the decision applies to employees in hybrid roles and those who already work remotely. Dave, this is interesting, though, because this is happening within the banking sector. And we know a number of the CEOs outside of Jane Fraser from the CEO of Citi, they have been very clear. They want their employees in their office, and they want their employees in an office on a very consistent basis. She, from the get-go, has been much more flexible in terms of work from home, the hybrid situation. So this 2 weeks at the end of the year is pretty similar to what they did in the summer when they let workers work from anywhere for the last 2 weeks of August.
I applaud Jane Fraser for this move. I mean, look, it's a tight labor market. If you start to see some bank layoffs, I'm guessing a lot are going to flood Citi's way. This is the new reality. The numbers show only 6%, this is according to Gallup, 6% want full-time in-office work. No one wants to go back to the office 5 days a week. 34% want fully remote jobs, 60% want hybrid. This is a real separator. And in times where you have to make tough decisions, you're going to stick with someone like Jane Fraser. You're going to stick with someone like Citi. You're going to work harder for them. And she has said all along that traders, for the most part, do want to be in the office 5 days a week. So she's probably not referring to the vast majority of her traders who need to be in the office.
Yeah, exactly. But it is important to point out that the rhetoric coming from Jane Fraser, and this has been consistent over the last couple of years, is very different than what we've heard from, say, JP Morgan CEO Jamie Dimon, who time and time again saying that he wants workers back into the office. He went as far as saying that people working from home, quote, doesn't work for people who want to hustle. So that type of environment, culture there, very different perhaps from what's playing out at Citi. But I think it's a welcome news there for the people who are able to work from home for the next 2 weeks.
Well, it's funny, we haven't talked a lot about remote work in the recent 6 weeks, 8 weeks, maybe even a couple of months, but the numbers are really petering out. They're really leveling out, according to Castle Systems, who tracks the swipes. We have really found a stopping point around 50% of return to office in New York City. So it appears to be one of those things where we have just stopped the return. I live in an entirely commuter town, and I've seen those numbers consistently tick up, people returning to work, but clearly is not the case.
Yeah, I was going to say, it seems like more and more people are on the buses in the morning, more and more people are on the subways in the morning, but I think the question and the big story to watch in 2023, if in fact we are seeing a leveling out now, clearly a lot of companies have way too much office space, they have way too much real estate, so what exactly happens to that end of the real estate market is going to be interesting.
Conversion. We hope conversion. This real estate guy wants to see office space converted into residential, but that is a heavy lift. All right, coming up, FTX drew some big celebrity investors and promoters. Now, some are getting sued. We'll discuss their potential legal liability next.
Trade? Are you sure? Not a trade. I'm trading crypto. FTX is the safest and easiest way to buy and sell crypto. It's the best way to get in the game.
Just trading crypto.
Oh.
Hey, y'all. It's not coming. Not coming.
Bro, it's been a tough year for Tom Brady, hasn't it? Brady among the many high-profile athletes and celebrities, including Steph Curry, Shaq, Larry David, Naomi Osaka, and several others, named in a class action lawsuit over their promotion of now bankrupt FTX. What exactly is their liability? Let's ask Tanya Evans, Penn State Dickinson law professor. Professor, great to see you. Thanks so much for being here. If you could walk us through this lawsuit, what is alleged these celebrities did and what is their liability according to the suit?
Well, actually, there are several suits going on right now. So this has been an insane season to really try and keep up. It's like drinking from a fire hose. But essentially, and specifically as it relates to celebrities, there's a Florida case that alleges unregistered securities as well as misrepresentation violations from those celebrities, some that you named. We have Tom Brady and Giselle, Serena, Madonna, Gwyneth Paltrow, a number of celebrities in various aspects of entertainment and sports who actually had endorsement deals with FTX. There's a range of potential actions from on the consumer side for material misrepresentation, but also how involved were they with respect to endorsement deals that may go from mere endorsements to brand ambassadors, which will be something that over time we'll have to see how the courts actually handle this. But there's certainly a lot of potential liability to go around.
A lot of liability. So you think these celebrities then could actually be held liable for Tom Brady, for example? Let's take that suit out of Florida. What is the potential liability there, I guess, just in terms of transparency?
So transparency is certainly one thing when you have a celebrity or anyone, quite frankly, that not only serves as an endorsement as a matter of commercials, and we can get into that, not only for individuals, but also sports teams and stadiums as well. But in addition to that, whether they had a direct and significant involvement in or whether they were the reason that consumers actually went to lean into the FTX products, not just about the FTT token, which is the token created by Sam Bankman-Fried and really propped up the entire FTX exchange, which was a crypto-to-crypto exchange. But an important part of this is when people would transfer money either to serve as investments or to be locked up in a yield-bearing account, or we call them a YBA. And that's really the crux of this, the connection between the products that were offered and the role that the celebrities actually played in that pivotal decision that a consumer that just doesn't have access to the same amount of information as a matter of vetting and actually participated and lost their shirt in the process.
Just want to be clear, we put up a lot of celebrities. Not all of them are at all involved in FTX. And it's separate lawsuits there. It is a Bored Ape NFT lawsuit. And that was the name: Kevin Hart, Gwyneth Paltrow, Madonna, Justin Bieber, Serena Williams, Jimmy Fallon, Snoop Dogg, Paris Hilton, and others. They are not involved with FTX. But if we put these back together, do you think they have much of a case, either of these lawsuits, against the celebrities?
The time will tell, because there's a more broad definition of securities under Blue Sky's laws in Florida than there is, for instance, under the Howey test from the Securities and Exchange Commission. And so that's going to be important. It's actually broader, and so it's more likely. I think they'll have bigger issues as a matter of the plaintiffs actually solidifying and certifying the class action suit against all of these. Right now, I think we have basically two named plaintiffs. They're going to have some work to do in order to show, one, not only that there's a number of people, and obviously I think that's the easier case to show how many people actually were impacted, but also that it's a manageable number as well. The size of the loss is something that we are just wrapping our brains around to actually figure out. But the concern for the plaintiffs is certainly going to be on the side of certifying that class. On the other side, for celebrities, even if you end up winning, you lose when you're sued. And so I'm concerned with the vetting process, because really they're trading on their goodwill. I'm an intellectual property lawyer in addition to a technology lawyer. And also, fun fact, I'm a former professional tennis player and I played on scholarship at Northwestern. So I actually care a lot about this topic and the impact, for example, with name, image, and likeness at the collegiate level too. The brand ambassadors here, obviously they've been sued, and it'll be interesting to see, and maybe also will come down to a matter of contracts, what their role is of going beyond just participating in a commercial versus actually being a brand ambassador and using their power, their influence, trading on their name, image, likeness, and reputation, where people would believe, well, I don't know much about this, but Tom Brady said it, so it must be okay. That's the concern here.
And you've also invested in NFT projects, and I'm curious, are you rethinking that moving forward? And as a professor, when you talk about subjects like this, do you tell your students, look, buyer beware here, don't take a celebrity's word for it, don't take a celebrity's Instagram for it?
It's always going to be buyers beware. Despite my work, I'm actually kind of risk adverse. I don't know how I found myself here. But as a matter of training the next wave of lawyers to actually represent folks who are operating in the future of work and wealth and creativity, it's important that we are training agents and lawyers to actually vet and be very clear about the endorsement, about the product and the service. Look, this is a lot different than a sneaker deal or a car deal or a sports drink. This is a financial product. And even if this is not specifically related to getting people to buy crypto, and some people have actually said that, right? Not just that this is a good platform, but I have my money there, you should too. That starts to go from kind of mere puffery or the type of commercial speech that we're used to and leans more into concerns about consumer and investor protection, to be sure.
All right, Professor Tanya Evans, thanks so much. Really appreciate this discussion. The crypto collapse does not appear to be worrying one major celebrity. Former President Donald Trump launching his own NFT collection. Trump fans will be able to collect limited edition Trump digital trading cards. And Trump being Trump, he shot a commercial for it. Listen.
These cards feature some of the really incredible artwork pertaining to my life and my career. It's been very exciting. You can collect your Trump digital cards just like a baseball card or other collectibles.
The cards will cost $99 and you can pay for it with a credit card or crypto. I apologize for the laughter. This is not about politics. That just appeared like a parody ad, but it is real.
It is real. And I think that also speaks to maybe where we are in crypto right now, because when you take a look at the NFT market more specifically, it's fallen off a cliff. I don't think that is the notion or really the sign for you to get back into the NFT market if you were in fact in it. Donald Trump, he's not selling me at least.
That is the strangest timing.
Very strange.
I mean, listen, that would probably sell
maybe
like
trying to capitalize on
hotcakes years ago, but that timing.
Maybe all the drama around crypto. He's trying to drum up some of the attention. We know he loves that. So an interesting timing, though, to say the least. All right, coming up, director James Cameron eyeing a career first when Avatar: The Way of Water hits theaters. We'll tell you what that is next.
Nearly 2 decades in the making, the Avatar sequel has arrived. James Cameron's follow-up to the highest-grossing film ever, expecting a monster $175 million opening weekend.
Do it.
Just breathe. Breathe.
I'm trying. I'm just so excited. The Way of the Water currently has an 82% critic score on Rotten Tomatoes. Let's discuss it with Paul DeGarabedian, ComScore Senior Media Analyst, and our own Ali Canal. Paul, great to see you. This movie looks outstanding. I cannot pretend that I'm not biased and excited to see it. Have you seen it? What do you make of the early reviews and estimates?
Well, I am seeing it in about an hour from now, so check back with me about 4 hours after that, because it's a 3 hour and 12-minute movie. The buzz on this movie is off the charts. I've talked to people, it's like they've been inhabited by something when they come out of the movie. They're like on this sugar high. And a long movie like that, you would think, oh, people come out exhausted. Seems like people just want to go back and see it again. That's great news. And as you said in the teaser here, this will give James Cameron his first $100 million domestic opening. Believe it or not, that's a great trivia question. His highest grossing opener domestically was the first Avatar with $77 million. So he's going to obliterate that opening record for himself this weekend for sure, Dave, for sure.
And Paul, I want to jump in here and pick up on that point. Only $77 million in the opening weekend, and then the film went on to become the highest grossing film of all time.
That's right.
So talk to me about how could this be a more slower burn? Obviously, the appetite is there, but will it be different than some of the Marvel Avenger films that we've seen?
Well, Ali, you make a great point, because when you look at Cameron's career, he's a marathoner. He's not a sprinter, both in terms of his output of films, but also in terms of box office. For example, Titanic, which we all know and love, opened in mid-December, like Avatar, the first one, and this Avatar, to a mere $28.6 million. It wound up with over $600 million domestically. That's a 21 times multiple, meaning of that opening weekend, it went on to earn 21 times that in North America, but over 1.8 billion worldwide. Avatar ranks as the highest grossing film of all time worldwide with close to 2.9 billion. But you're absolutely right. It may be a slower burn. It's a long movie, although I don't think that's going to hurt its potential this weekend, because what theaters are doing is they can open up every screen or every auditorium to The Way of Water, because the demand will certainly be there. And we're already seeing that in the numbers. So I'm really excited to see it. I know a lot of people are. And the movie industry needs this movie right now. We've had a slow post-summer period. Wakanda Forever was #1 for 5 weekends in a row. And now we're looking for Avatar, The Way of Water to take over that mantle.
Yeah, and the buzz and the reviews will likely help with that opening weekend performance. And talk to me a little bit about the China aspect of this all. China has been very notorious with rejecting films. The Way of Water did get that green light. But is there potential risk, especially with China's zero COVID policy?
Well, I think that those exterior forces could come into play. But I think most importantly for the movie is that by getting a movie like Avatar into China, and remember, China for the first film was the second biggest market for the original Avatar film. So this is very important. And IMAX and 3D large format play a huge part in this. And in China, that's the second biggest movie market in the world. So it's a big benefit for Avatar, The Way of Water, to have China in the mix. No question. When they announced that, that was big news for the film. And with Cameron looking for one of the top grossing films of all time to add to his already illustrious box office career and to greenlight the next 3 installments, you're going to have to make a lot of money on this one. This is not an inexpensive film, and this is a long-term commitment. This is a legacy project for Cameron. So the stakes couldn't be higher.
Yeah, it essentially has to be the highest gross film ever just to make any money. The next blockbuster could actually be college football. Cinemark is pairing up with ESPN to show the college football playoff. How does this work? Could it open the door to more sports in movie theaters?
Oh, Dave, this is absolutely incredible. Movie theaters need content. They need movies, but they also love, especially midweek and even on the weekends, to have great, what we call alternative content for their screens. We've seen this with Fathom events, Trafalgar, Iconic. We've seen a lot of events like this. Met Opera. If you want to see an opera, you can go to your movie theater. If you want to see Coldplay or BTS, you can see those groups in a theater, the musical groups. And so that's really a great thing. Video gaming is big. There was a League of Legends event that people were able to go to the movie theater to watch or play video games, and that's huge for theaters. Sports is a new frontier, I think, both for the streaming side of things and also for movie theaters. Live sports, it could be huge. The potential there is quite amazing.
And Paul, with that, when we close out 2022, head into 2023, what sort of lessons have we learned? And with those opportunities, sports, maybe even more streaming exclusives in the box office, where do you think we go from there?
Well, I think the lesson learned is that you need a lot of movies and you need them coming out evenly on the release calendar. So for instance, in our ComScore data, we've shown this year to date, we have 38 fewer wide release films than we had in 2019. That's a lot of movies. That's potentially $1.5 billion worth of domestic box office. So next year it looks a lot more evenly spaced with, Ant-Man coming out in February, John Wick after that. You've got Mission Impossible 7. You've got some really big movies, Indiana Jones 5. I could go on and on. So many big movies, but the lesson learned is if you build it, they will come. I know it's a cliche, but when the movies were out there in the summer, we saw the box office explode, but there weren't as many films in the post-summer period, and thus we saw the box office drop and perhaps people migrating home to watch content on TV. But if it's out there in the theaters and it's appealing, like Avatar, like Puss in Boots Yet to Come, the Whitney Houston movie, there's some really good movies on the horizon, and Babylon, of course. I think those movies will draw people to the theater now and into 2023 and beyond.
Excellent. Can't wait for your review. Paul DeGarabedian, Ali Canal, thank you so much. Coming up, struggling to find cough medicine? Well, you are not alone. We'll tell you what's going on. And we saw plenty of movement on Wall Street during today's session. See which stocks are making the biggest moves after hours next. Sales of over-the-counter cough and cold medicines have climbed 35% in the last month. That's according to data from Nielsen, causing shortages at pharmacies and online as the nation is gripped by a spike in respiratory infections. For more, we're joined by Yahoo Finance's Anjali Kamlani. What's the deal here?
Well, Dave and Shauna, the cough and cold medicine shortage, really a result of what you just said, the triple-demic, as we know we've been talking about. You've got COVID, you've got flu, you've got RSV hitting the population all at the same time, and that's resulting, of course, in a shortage of these available medicines. Now, the kids section of that of those drugs has really been hit hard in the last several weeks. You've been hearing about that, parents running around trying to find providers, even running around trying to find those medications. And now that's spilling over into the adult population, tracking pretty well with the climb in hospitalization that we've seen around the country. So really not a surprise. It actually does reflect what we saw last year as well. I'd forgotten about this until I saw this report as well. Last year, we also had a shortage in cough medicine supply. So it's just the, just a worse version of what you expect to see now with the respiratory viruses circulating.
All right, Anjali, stay with us because we want to continue talking about this hospital struggling with the brutal trio of RSV, flu, and COVID. COVID cases are increasing so much so that the government is issuing free COVID tests again. To discuss all of this, we want to bring in Dr. Calvin Sun, attending physician in emergency medicine and author of the Monsoon Diaries. Dr. Sun, it's great to have you again. It's been a while since we spoke, which is actually good news just in terms of where we were in the pandemic. But give us a sense of where we are today with COVID cases rising and the fact that we are seeing RSV and flu cases on the upswing as well.
We used to say Christmas came early this year, but in our case, flu season came a month earlier. And I think what we didn't expect was how RSV and COVID came with that. And what we're dealing with right now is a supply issue, not only the medicines that we have available for people, but also the testing, what to test for. I think our resources have been strapped in every year. I think we get deja vu when we enter on this holiday season. And you got travel season, you got the holidays coming up, so even more of a chance to have these rates increase higher. So this is nothing new. We've been through this, but at the same time, it is a little overwhelming when you had not only just flu, but COVID and RSV. When the kids get sick, the parents need to take care of those kids, and they get more tired, and they're more likely to get sick.
That's right, Dr. Sun. Anjali here. I know that to help combat this, the White House has come up with a plan, specifically with the addition of reopening the tests to send home. They're also talking about partnering with the local government leaders as well as health systems. Federal personnel and resources are being deployed, monitoring those subvariants. We know now the dominance of BQ1 and BQ11, and then specifically focusing on the more vulnerable population. So it seems like that kind of encompasses the right tone. It strikes the right tone in sort of what to watch. But what's the reality on the ground? Do you see the resources being deployed? Do you see, with the rise in cases, that tracking?
We have to test for both flu and COVID when people come into our emergency rooms or urgent care centers. RSV is a little trickier. We usually reserve that for pediatric populations. But when the symptoms are very similar, we should test for both. And what happens is that we end up running out of flu tests and COVID tests. So having these at-home tests being given to Americans around the country does take up off a little pressure from our emergency rooms and urgent care centers to having tests, because they don't have to come to us anymore. They can just check at home. And those tests are just as good as the ones that you find in rapid tests, at least, the ones that you see in hospitals and urgent care centers. So it does save you a trip and saves you from catching another virus in a healthcare facility. Where do you think all those people with symptoms are going to go when they want to check if they have the flu or COVID? They're going to come to us. And when you're not as sick, but you may be thinking that tickle in your throat could be one of those viruses, you end up catching that party favor you never asked for by coming to us, when you could have saved that risk by testing at home.
Good to see you, Doc. The White House says COVID cases are up 90%, which is staggering considering no one I know is even testing. So to hear that number is surprising. And COVID fatigue isn't just setting in, it is baked in. Do you get any sense of how well prepared we are for a winter surge in terms of boosters?
I think that with the bivalent boosters that we have, it's been very tremendous in lowering the hospitalization rates. Just like seatbelts don't prevent car accidents, but the availability of flu shots, I know that this year's flu shot has been really good at reducing hospitalization rates from countries who had their flu seasons earlier than ours. So we're very confident that those who get the bivalent booster and the flu shot, I got mine both at the same time, And now I'm doing great. That was just 2 months ago. And I haven't gotten sick, even though I'm constantly exposed to people who are sick and have symptoms. I haven't gotten it yet. And if I were, I know that the severity would be lessened to the point where I don't have to worry and I will end up in the hospitals. And those that 90% or whatever statistics you hear, those are the people who are testing, but really it's also the people who are being tested. So those who are not testing, they're maybe even greater, but the figures that they get sent are those that are being tested because they're presenting with illness. They are being hospitalized or admitted to the hospital, and they have to get tested with COVID or flu, so they get cohorted to the right places. So those are the ones that are sick enough to get tested in the first place.
So Dr. Sun, where does this leave us on masking? Because at a time when we haven't really had mask mandates for quite some time, we're hearing more and more about the fact that we should be masking. So what would you tell patients in terms of when they should be wearing a mask right now and when they don't have to worry about it?
Obviously, we live in a country where if you're being told what to do, you may get a backlash and a worse outcome when people, out of defiance or pride or fear, do the opposite of what you would recommend. So there's a way of communicating of how I like to approach it is like with vaccines and masks. No one's forcing you or looking over your shoulder or arresting you or doing whatever, that you're afraid they might be doing to you if you don't do something. It's on your conscience. There are consequences. And if grandma gets sick and dies because you got her sick because you refused to mask around her out of pride or fear, or whatever it is, or you decide not to get vaccinated when you visited your family and get, grandpa's sick and they're in the hospital later on, those are vulnerable populations. That's on your conscience, and you have to accept those consequences because you didn't do something that you could have. If you decided not to put on a seatbelt, there are consequences when bad things happen, and you have to own that consequence. And people hear it this way, they do consider it a little more seriously. And if that, tips the needle a little bit, it does make a huge difference.
Dr. Sun, I know there was a recent report looking at the immune evasiveness of the new variants compared to the boosters, as well as now we know there are no antibody treatments. I wonder, there's a lot of focus on the case rise, but can you give us a little context about the hospitalization and those who are contracting severe disease? What do you see in terms of who is actually still contracting this disease at a severe level?
It's the vulnerable populations, immunocompromised, the elderly, and the very young. I mean, we've said this before. It's been 3 to 4 years since most of us have been vaccinated, and most of us are fine. There's an adult population, but the ones that need constant boosters, the ones that need the bivalent vaccine, the ones that are urged to vaccinate earlier, are the vulnerable populations because they're the most likely to get hospitalized and overwhelm the hospital system. We don't want it to collapse because once we run out of beds, where are people going to go? People are concerned because the vaccine doesn't prevent all illness. Well, seatbelts don't prevent all car accidents. Bulletproof vests don't prevent getting shot. Helmets don't prevent a brick falling on your head, but it does reduce the possibility, the chances that you're going to end up in the hospital and taking up an otherwise unnecessary bed. And the vulnerable populations are more likely, just by a baseline, without even getting sick, to take up a hospital bed because they're vulnerable. And therefore, when you get them something like a tridemic or tripledemic and the holiday season and everyone's staying indoors and families are getting together, that's the perfect storm for them to increase the hospitalization rate at an exponential rate when the season happens. And that's what we're seeing right now.
All right, got to leave it there. Dr. Calvin Sun, Anjali Kemlani, thanks so much, both of you, for being with us. Shauna, let's take a look at what's moving after hours.
All right, Dave, we got two stocks for you here. We have Adobe and US Steel. Let's start with Adobe. Those shares up nearly 6% in extended trading. Strong performance here from the company's most recent quarter. Better than expected profit. Adjusted EPS of $3.60. That beats what the street was looking for. Revenue essentially in line at $4.5 billion. Revenue guidance a tad light here, but it looks like Wall Street is focusing on that beat. We can see the stock up nearly 6% after hours over the past 3 months. We're looking at gains of just about 6% year to date, though. Adobe well in the red on the heels of what has been a very tough year for the sector. You're looking at losses of just about 42%. Let's take a look at US Steel. That stock on the move after hours, up just about 3%. The company fourth quarter profit forecast was stronger than what the street was looking for. That's pushing shares higher after hours. The CEO there saying that he is seeing improvement in commercial demand. Also the fact that scrap prices are increasing. So United States Steel moving to the upside over the past 3 months. We're looking at gains of just about 16.5% year to date. just in the red, right below the flat line, off just about 0.7%.
Thank you, Shauna. Let's talk about my stock to watch for tomorrow. That is Accenture, which reports its first quarter results before the bell. Analysts expect the professional services company to report earnings of $2.90 a share on revenue of $15.6 billion. Accenture shares have been beaten up this year, down more than 30%. Investors will be looking for any indication companies are pulling back on spending over recessionary concerns. Coming up, who doesn't love a good Christmas cookie? We'll tell you which Christmas-themed treat was the most Googled in each state when we return.
The office holiday party is back. A new survey by executive coaching firm Challenger Gray and Christmas finding that over half, 56.9% of companies say that they are having in-person holiday parties this year. That's up from just over a quarter last year, up from just 5% in 2020. I don't think that's a big surprise. I'm actually surprised that 5% of companies had a company-wide Christmas parties in 2020 in the midst of COVID. Yahoo's company party is actually tonight. Both you and I will be going to that. I don't know if I should be surprised whether or not only half or just over half of companies are having Christmas parties. I would have guessed that that number would have been a little bit higher given where we are today. Yes.
I am absolutely floored by that number.
That's
I thought
too
it'd
high
be
or
around
low?
high.
Really?
57, I thought it'd be in the 30 range.
Why, just because of COVID
Peak.
or working from home?
I just thought once we started getting rid of the Christmas party, whether that was COVID or cost, that it was one of those things that would evolve out. It would just disappear from the landscape because companies realize, what were we spending 20, 30, 40, whatever it is, grand a night? We can do without that. I am shocked to see it come back in that kind of force, in particular, given the sense of the economy. We could be heading into a recession. I thought it'd be around 30%, quite frankly.
A couple of months from now, you're right. If we had waited for Christmas, maybe that number would have been a little bit lower. But I will point out, now with so many people working from home, I think companies might be more incentivized to throw a Christmas party because they want to bring everyone together. They want to create that culture that they don't have on a daily basis. They want to get everyone
stuck the
in
landing
one
right
room.
there.
So
I
that's
didn't see
my
that.
theory. That's why I thought it
well
was
played.
A little higher.
And what's a holiday party without cookies? Google released the most searched for Christmas cookies state by state. And I know you've done extensive homework on this, Shauna, in terms of who likes what cookies. Gingerbread is the only one I truly like on this list.
Oh, you're missing out.
Okay,
There's a
tell me
peanut butter
why.
cookie. So I'm from right outside Philadelphia. And so Pennsylvania, the top Christmas cookie there is something called a peanut butter blossom, which I actually didn't know the name of this cookie. It's a peanut butter cookie on the bottom, a Hershey Kiss in the middle of it. My mom made it still makes it every single Christmas. By far my favorite. So I'm very happy that I line up with what my state apparently prefers, according to this Google trend. What caught me a little off guard, there's a number of cookies on this list that I had never heard of. A hot chocolate cookie. Have you ever had one?
Didn't know that was a thing.
Didn't know that was a thing. We have a number of others. There's Christmas cookie bars. I haven't had that either.
We got some
Washington
cookies.
State's.
You're going to have to do the goodbye because I'm going to
Yeah,
eat.
I know.
We're
going to do it with our mouthfuls. That does it for us today on Yahoo Finance Live. We're going to head to our Christmas party. But thanks so much for tuning in. We'll see you right back here again tomorrow afternoon. Have a great night. Happy holidays.
I need some milk, though.